of thinking about the different types of risk organisations face. We're going to introduce one categorisation that you may find helpful in dividing up different areas of risk. It's important to stress, though, that none of these categorisations are official. There are many categorisations you can use, and the really important skill that we're going to practice in this chapter is being able to identify risks for any given situation or organisation. We'll then look briefly at the relationship between risk and return and some of the key principles that you need to be aware of in thinking through risk for this paper. Okay, so we'll start off by looking at what we mean by risk. Well, there are lots of technical definitions out there of risk. The official CIMA one is a quantifiable dispersion in possible outcomes. In other words, things may not turn out the way you expect. Now, it's worth saying that strictly you can talk about risk in two different senses. There is downside risk, that things turn out worse than expected, but there is also upside risk, where things turn out better than expected. This is if you're using the technical definitions. However, in this paper, you don't need to worry too much about the definitions, because there's a much more practical, common sense way in which risk is interpreted. What risk basically means in this paper is what could go wrong. So what could go wrong and have some sort of impact on our ability to achieve our objectives. So when you're asked for risks, as you will be undoubtedly in your exam paper, that's what you need to think. I'm looking for what could go wrong in this situation. Now, in theory, uncertainty is a slightly different concept. Again, talking about technical definitions here. Uncertainty is about the inability to predict an outcome. So uncertainty means there are things we just don't know. And the future, by definition, is uncertain. So this is always a factor in making decisions. And again, drawing the distinction in terms of the technical way of looking at these things between risk and uncertainty, difference is that risk is actually quantifiable. It's possible to put some sort of number, maybe an estimate on it, whereas uncertainty cannot be quantified. It's things that are simply unknown, and there's nothing much we can do about that. The first lecture example of the course is in some ways one of its most critical. One of the skills you will need for this paper is the ability to look at an organisation or a situation and identify what the key risks are in that situation. What are the really important things that could go wrong? Now, this is an exercise I'd encourage you to do throughout the course. I'd encourage you to do it for your employer, for companies you read about in the press, for any other organisations you're familiar with, thinking about what could go wrong. And then, as you'll see later on, you also will need to think about how can we prevent those risks, how can we control them. Now, to get you started here, we're going to take an example of a very high-profile, well-known organisation that has lots of risks we can think about. We're going to take British Airways. So have a think about key risks faced by British Airways, and I'll emphasise that word key. There's probably lots and lots of risks you could talk about, but what are the really important ones? What are the ones that senior management should be concerned with, and why? So have a think about that, jot down your ideas, and then press play when you're ready to go on to the debrief. So what are the important risks faced by British Airways? Well, I'd stress there's a long list here, but here are some of the ideas you could be thinking about. Firstly, building on the fact that British Airways is very much an upmarket carrier, one of the risks they're going to face is a fall in demand due to recession. Companies like British Airways that operate towards the top end of the market are very vulnerable to an economic downturn, which will mean that people cut costs, and therefore perhaps they'll trade down to cheaper airlines. Particularly a factor given that BA draws a lot of its business from the corporate sector, from business travel. A second risk we could mention is rise in oil prices. Airlines consume a huge amount of fuel, and the price of oil is notoriously volatile. So an increase in oil prices is going to increase their cost base and damage their profits. A third risk, and one that BA has been very much vulnerable to in the past, is industrial action. For various reasons, labour relations are not always that great, and staff sometimes go on strike. That will disrupt operations, it will damage their business, it will deter customers. They also have a risk of bad weather disruption. So if there are storms, for example, that can disrupt flight, or even, as we have seen in the past, volcanic ash clouds that can ground flights altogether. That is something outside their control, but it has a very damaging effect on their business. It might even deter people from flying altogether in the future. It may be that safety concerns is a risk. If there, for whatever reason, there are concerns that flying is unsafe, that there's perhaps an increased risk of a terrorist attack, then again that is going to hit business. People are going to be reluctant to fly, to travel. They're going to travel by other means, or perhaps avoid travelling altogether, do things like teleconferences if it's business travel. And another final risk we could mention here is safety. Flying in a metal tube many thousands of feet above the Earth carries its risks, and there is a potential risk of injury either to passengers or staff. Now clearly an injury like that, not only a bad thing in its own right, it is going to damage the business because it's going to make people not want to fly. So other things you could say, but that's a list to get you started of some of the key risks you would expect senior management at British Airways to be focused on. Okay, in this next section, we go through a number of different categories of risk. In other words, if you've identified lots of risks, how might you divide them up? We're going to do this for a number of reasons. Firstly, it can provide a sort of checklist that you can use to generate ideas about risks an organisation faces in a certain given scenario. If you are stuck, you can run through these in your mind, and some of these are likely to be relevant to any scenario that you face. Secondly, there are sometimes exam questions where you are asked to categorise risks. You're asked to group them into some sort of category. Now, one very important point to make is that if you are asked to do that, there is no one standard official way of categorising risks. There are lots and lots of ways of categorising risks, and if you're asked to do this in an exam question, you will be expected to adopt some categories that are appropriate to the organisation that you're looking at. So please don't get hung up on the idea that you must use this particular list. But this particular list can get you started and give you some ideas and show you what a categorisation looks like. In particular, in an exam question, you probably wouldn't have as many categories as this. The other reason why we're going to go through these categories is to give you some idea about the breadth of risks that you may need to think about and consider when you're looking at a scenario. Okay, risks come in all kinds of different shapes and sizes, and this list will give you some ideas about that. Now, one high-level way of dividing up risks that may be useful is to divide them into strategic and operational risks. Strategic risks relate to long-term issues facing an organisation, and in particular, their relation to the environment. Using environment here in the sense of anything outside the organisation. So primarily we're looking outward and we're looking on long-term. Operational risks, by contrast, are day-to-day. So these are risks that result from your day-to-day operations, much more short-term and more likely to be internally focused rather than externally focused. It's to do with your actual internal operations. Now, I should say that the distinction between strategic risks and operational risks is not hard and fast. There is quite often some grey area, and it may be that there are certain risks that fall into more than one category. To give you an example of this, one of the risks we'll look at under operational risks is health and safety. And normally health and safety is considered to be a day-to-day operational risks in terms of how you run yourself. However, you may recall that for BP a little while ago, they had some very major health and safety issues with some of their plants in the US. Some of those plants had had accidents, some people had been killed, injured, and it became very, very serious. It became so serious that the chief executive was dealing with it and actually announced to their investors and to the press that profits would be reduced because of the investments they were making in improving their health and safety. So for BP in that situation, health and safety wasn't really just an operational risk. It actually became a strategic risk as well. And sometimes that can happen when these operational risks become very, very significant. So just be aware, there is some grey area between the two. There may be some crossover, but it can be helpful in general terms to think about risks in these categories. Now a further subdivision that again can be useful relating to strategic risks is between business and non-business risks. Business risks relate directly to the products and services that are provided by the organisation. So as we'll see, they result from what you do. They result from your actual business model. The non-business risks basically don't relate, or at least don't relate as closely, to your products and services. So they're not things that go wrong with your products and services. They're things that go wrong, as we'll see, either with your financing or perhaps with events happening in the outside world that you have no control over. Firstly, we're going to talk about some of the strategic business risks that an organisation might face. Now, one category is product risk, and this can be very simply identified as the risk that your product or your service doesn't sell. So for whatever reason, people don't want to buy your product. Maybe you've chosen the wrong product to deliver, or maybe your product simply isn't good enough and people don't want to buy it. Second category of risk is environmental risk, so risks that directly relate to what is going on in your environment. And you can break down environmental risk using a model that I'm sure you're very familiar with, the Pestel model. You can think about Pestel in terms of risks. There are political risks. There are risks relating to things that government might do that will damage your business. There are economic risks, so in particular relating to the economic cycle. So there's a risk, for example, that a recession causes a reduction in demand for your product. There are social risks to do with people and social trends, which in the long term damages your business. There are risks connected with technology. Perhaps technology is going to advance and you're not going to keep pace with it. There are risks relating to environmental issues, as we saw, for example, with British Airways. Climate change may have an impact on your business. And there are legal risks. There are risks relating to change in the law. So it's one way you can adapt the Pestel model to generate some ideas about risks that are out there. You may have stakeholder risks, which are connected with your relationships with your key stakeholders. For example, you may have risks connected with your investor relationships. Perhaps your relationship isn't going so well and investors sell your shares. You may have risks connected with your supplier relationships. If your supplier relationships are poor, that may damage the quality of your product. Employee relationships, over the long term, if those aren't good, you may get low employee morale. And relationships with your customers, which again, if they deteriorate, will lead to a lack of demand for your product. And finally in this category, you may have investment risk. This is quite simply the risk of making a poor investment decision. So either you have decided to invest in something, in a particular project, when you shouldn't have done, actually it wasn't a good investment, or you didn't invest in something that actually would have been a good investment. So you make the wrong sorts of decisions. So this is not comprehensive. There are other business risks you might think of, but it's a pretty good way of thinking and generating some ideas about the business risks any given organisation faces. The second category of strategic risks are non-business, so these don't relate directly to the products and services that you provide. Two categories here, the first of which is financial risk. Now this is a very big part of your syllabus. We're going to spend quite a bit of time later on in the course going into a bit of detail about financial risk. But just to introduce what financial risk means in the context of P3, firstly it means risks relating to currency movements. So any organisation that trades internationally or has international operations is exposed to things going wrong relating to currency movements. That's not to do with your business, it's outside your control, but it generates some risks and you need to deal with them. Secondly, there are risks relating to interest rates. So if you are a borrower, there's a risk that interest rates go up. If you're an investor, there's a risk that interest rates go down. There are various ways of dealing with that. And thirdly, there are risks relating to commodity price movements, or possibly other market prices that you may be exposed to. And if the markets move a certain way, then you may have a risk of loss of income, reduction in your value of your asset base, or other similar risks. So that's financial risk. We'll come back to that in a lot more detail later on. And then the second category we deal with here is event risk. And this is some sort of outside event that you have no control over that has some impact on your organization. Classic example would be something like weather, extreme weather. There's a hurricane or there's a snowstorm or something like that, and that has an impact on your operations. That would be classified as event risk. Could also be something like legal action. It comes out of the blue and again has some sort of impact on your operation. So that's what we would term event risk. And then the final category of risks we look at is operational risks. Remember, these are the day-to-day, short-term, internally focused risks. Now there are many categories you could use here, and we'll touch on some of them. Firstly, we have risks relating to information and IT. So there's a risk, for example, that you have poor quality information in the organization, and this leads you to make bad decisions or lose competitiveness. There are also risks specifically relating to IT, for example, systems failure, as well as risks such as hacking, viruses, and so forth. Now we'll come back to this later on in the course. It's a very, very key area in this course, so we'll go over that in a lot more detail later on. Secondly, there are risks relating to compliance. So all organizations need to comply with the law in their jurisdiction, and they may also need to comply with applicable regulations. Particularly for organizations in very heavily regulated industries, such as, for example, financial services, or maybe telecoms. This could be a very major factor, ensuring that they comply with what the regulator wants them to do. Clearly, if they don't comply, it can result in fines and also reputational damage. There are risks connected with wastage, so excessive costs. Maybe you're paying more for your materials than you need to, and perhaps inefficiency, that your assets are not being used as efficiently as they might be. There are risks relating to reputation and ethics, which are particularly highlighted in this syllabus, and we will come back and look more closely at the issue of ethics. But organizations do face a risk of loss of reputation. Reputation is an extremely valuable corporate asset for many organizations, and if they are seen, for example, to be behaving unethically, then it may mean that people don't want to deal with them. Perhaps they find it harder to retain employees or to win new business. There is a risk of fraud, again something we'll come back to, look at in a bit more detail. Fraud refers to some sort of deception, and it is usually committed by employees. That is by far the most common type of fraud. So organizations need to be very vigilant as to the risk of employee fraud, and there are steps they can take to try and reduce that risk. And then finally, one we mentioned earlier on, there are risks connected with health and safety. There's an obvious risk that an organization has loss of employee time due to injuries or accidents or sickness. There's also a risk perhaps they may need to pay compensation or fines if they're shown to breach health and safety regulations. And health and safety issues, as we saw with BP in the example earlier on, can result in reputational damage. People probably won't want to work at an organization where they don't consider that they are safe, and other stakeholders may not want to deal with them either. Now again, I'll just repeat the point. This is not every category of risk you might want to think of, and this is not an official categorization that you must use in the exam if you're asked for categories. This is an example of how you can categorize risks, just to give you a flavor of what categorization looks like, and so you can generate some extra ideas. But if you are asked for categorization, please produce something that is tailored to the scenario that you've been given. The next lecture example asks us to apply that categorization to the risks that have already been identified. So what I'd like you to do is go back to the risks you identified in lecture example 1, whether for the pre-seen organisation, for your employer, or for British Airways, or indeed any others you might have done, and see if you can identify appropriate categories for the risks that you have identified. You might also want to have another look in the light of the categories we've discussed and see if you can identify any additional risks that perhaps you hadn't thought of before. So press play when you're ready to debrief that for British Airways. So let's have a go at categorizing these risks, and remember, categorizing risks has been an exam requirement in the past, and also add in any others we can think of. So if we go back and look at our list, we can think, well, what is fall in demand due to recession? Well, that we would probably call economic risk. And that's the E in pastel. So it's something to do with the economic environment that has an impact on our business. Downturn in the economy, particularly as we've seen, will influence someone like British Airways. A rise in oil prices, well, that we would categorize as financial risk. Later on we'll look in some detail at financial risk in this course, and you'll see that fluctuations in commodity prices can be a key element of financial risk that can affect organizations. Industrial action, well, that we would probably categorize as operational risk, something at the grassroots that can get in the way of executing on your strategy if workers are going on strike. Bad weather disruption, or worse, we'd categorize as event risk, something that simply happens, comes from the outside your control, sudden, unexpected event. Safety concerns, causing people to fly less, well, that really is social. Again, the S in pastel. So it's a change in attitudes, change in society, change affecting people that again has an impact on your business. And then injury to passengers or staff, well, that we would categorize as health and safety risk. Health and safety is in one way or another an issue for most organizations, but as we've seen, for airlines more than most. Is there anything we can add to our list, having looked at our overall categories? Well, there probably are a few. Financial risk, as we've seen, includes risks relating to currency movements, foreign exchange risk. Now, for an organisation like British Airways, by its nature, is highly multinational, operates all over the world, dealing in all kinds of different currencies. So it will be vulnerable to foreign exchange risk. Again, much more on that later on in the course. Perhaps there's also political risk. Airlines tend to be very heavily regulated. Governments take a keen interest in their operation. They are politically sensitive organisations. So perhaps there's going to be a change in regulations. Or maybe even tax. Flights are taxed, for example, in the UK. And changes in that could affect your business. And then perhaps we could talk about compliance risk, leading on from that. There is a lot of regulation, particularly around safety for airlines, and a change in those can influence you. In addition, there is always a risk that you don't comply with the regulations. So if you don't comply, then that can lead to fines and most likely reputational damage. Now there's much more, but hopefully that illustrates the way looking down a list of standard risks can help you to generate some extra ideas. Again, this is a skill I would strongly encourage you to practice as much as you can with a wide range of organisations. Another fundamental concept we're going to touch on in this chapter, which is really recapping a bit of finance theory, is the relationship between risk and return. Now there are lots of discussions about this, there's lots of learned books and articles written about this and so forth, but the fundamental principle is that there is an inverse relationship between risk and return, and that in general, the higher the risk, the higher return you should expect, and the lower the risk, the lower return you should expect. So expected returns for a company should be higher if activities are more risky, and lower if activities are less risky. Now, if we think about this in terms of investors, there are two types of investors broadly. There's investors in debt capital and there's investors in equity capital. Investors in debt capital, in other words lenders, generally have less risk. And there's two reasons for this. Firstly, they are guaranteed their return. So a company must make its interest payments, whereas a company is free to decide whether to make dividend payments or not. So if you have lent a company money, you know that you will get your interest payments, unless, of course, the company goes bust. Second reason why your risk is lower is because if you are in a liquidation situation, or some sort of winding up situation, you are paid first. The lenders will be repaid before shareholders. So even if things do go wrong, you are more likely to get your money back than shareholders are. So lenders, providers of debt capital, have less risk. Equity shareholders, on the other hand, have dividends as their return, which are uncertain. The company can decide whether or not to pay dividends, and they are the last to be paid in a winding up situation. It then makes a lot of sense to see that lenders, providers of debt capital, have lower returns. In other words, debt is cheaper than equity. It's cheaper than equity because providers of debt capital take less risk. Equity shareholders have higher returns and will expect higher returns. Let's put it another way, cost of debt is going to be lower than cost of equity. Now there's another reason why that's true, of course, which is tax, but we're not going to dwell on that in this syllabus. It's not something we generally deal with. But from a risk point of view, we can explain why debt is cheaper than equity. Now it's important to understand that no one is advocating that organisations can or should eliminate risk. Risk is just a fact of life, it's part of your operations. So organisations will always be exposed to risk. There will always be a what could go wrong. Companies, commercial organisations in particular, need to take risk. They will take risks in order to get a return on their investments, which they can deliver to their investors. However, what managers of commercial organisations will do is they will reduce risk where they can and where they think it's appropriate, and for any given level of risk, they will look to maximise returns. So risk is always going to be there, it just needs to be managed down to an acceptable level, to a level that's compatible with the sorts of returns that they're looking to generate. The next lecture example illustrates some key ideas about risk and return by using a highly simplified example with some numbers. Let's say we have two investments, and just to avoid the cop-out that we'll do both, let's say they're mutually exclusive. Each of them has an initial outlay of $200,000. You've then got a little bit of information about them. So project A, you invest your $200,000, you're guaranteed to get $250,000 back. Project B, there's a 50% chance you get $400,000 and a 50% chance you get $100,000. A couple of questions here to think about. One is, which one would you do? Have a think about that just for a minute or two. See what your ideas are. And then have a look at what factors would you consider. So what would you take into account when you're deciding which one of these two projects to do? So this is illustrating the risk-return trade-off. Have a think about that for a minute or two, and then press play when you're ready for the debrief. Okay, so we've got some data about the two possible outcomes of the project. And probably where you started was doing a quick expected value calculation. The expected value of our return in project A is $250,000. The expected value of our return in project B, well, is the same. We've got 50% times 400,000 gives us 200k, and 50% times 100k gives us 50k. So the expected value of project B is also $250,000. So that doesn't help us, it's going to be the same either way. The difference between the two is that with Project A we know exactly how much we're going to get. In other words, we have no risk. With Project B, there's a chance that we're going to make 400,000, there's a chance we're going to make 100,000. In other words, we have some risk. Now if we go with Project B, there is actually a chance that we'll make loads of money, but there's also a chance we're going to lose some money. So, what would you do? Well, what it's going to depend on, the factors you're going to consider, basically something we'll talk about in the next chapter, something called your risk appetite. How much risk do you want to take on? Most organisations would actually go for Project A because the return's the same and there's no risk involved. However, an organisation that was particularly risk-seeking might go for Project B because of the chance of the upside. If you were being a complete cynic, you might also wonder about the quality of your data. As we know, the future is always uncertain, so do you really know that you are guaranteed to get your $250,000? Do you really know that the chances are 50% each way with Project B? So you might want to ask some questions about that and be reassured about that before making your decision. But there isn't a right answer in terms of which ones to choose. It depends on how you feel about risk. Okay, so let's just summarize what we covered in this chapter. We looked at the technical definition of risk, variation in possible outcomes. But remember, for our purposes, the question is, what could go wrong? That is, for all intents and purposes, what risk means in this paper. There is possible to talk about upside as well as downside risks, could be favourable as well as unfavourable, and what organisations need to consider, and the fundamental theme of this paper, is how much risk they're happy to take on and how they can manage those risks they don't consider acceptable. We looked at categories of risk. Now there isn't a standard form for categories of risk, but we went through an example, a fairly comprehensive example of different categories you could think about, which may be helpful in terms of generating ideas for risks faced by an organisation, may also be useful if you are asked to do some categorisation yourself. And then we talked about the trade-off between risk and return. Broadly, there is an inverse relationship between the two, and what organisations, in particular companies, seek to do is manage risk down to an acceptable level and generate the best return they can at that given level of risk. Taking risk, remember, is not unacceptable. It is a business necessity. No one is saying in this paper that you should reduce risk down to nothing. There are going to be risks, but you may need to manage them down to a level you consider acceptable.